Hello everyone, welcome with so make that effective interest method table. Many students actually, even though if it's very simple, some students do make some errors here and there or don't know how to make a table. But this table is relatively very simple. So we will just look at how to actually read this question and understand and how to make that effective interest table. And we will do two examples here. One would be discount with discount, and one would be premium. I'm going to explain what that means as well in this video. So let's get started and read the question first. Standard Pacific Shipping issued $5 million dollars face amount of 5% bonds on 1st January 2003. The bonds are 5 years bond, and interest is payable every year. At the time of issue, the market rate of interest was 6%, so the bonds were issued at discount. Now, most of the times, actually, in this question, I already stated that the bonds are issued at discount, but you need to understand what the discount and premium here means. Actually, by discount, it actually means that it was issued at less than $5 million, right? So the cash received by the company, which is Standard Pacific Shipping, is less than $5 million actually, and we will calculate that number too, and you will see that that number would actually be less than five million dollars. Um, so right, so we will need certain. I would say this is period. We will need certain information from the question. So I have already made that table, but I'm going to explain that as well. And I will also explain why this is a discount bound and why it is issued at discount. Right, so the period is 5 years, which is again coming from the question. Then the discount rate, which we will use to calculate the present value, which is going to be less than $5 million. So that's how we will calculate that. We will calculate present value. If you're not familiar with the term present value, then I already have a video about time value of money, which is coming, and these concepts have been discussed in that video. And I've also explained, or I do have a video on how to calculate these numbers and using Excel actually, right? So discount rate is 6%, the coupon rate is 5%, and the face value of the bond is 5 million, right? So you see there are two different rates. Now, discount rate is coming from market. That's 6%. That's the market interest rate, right? And the bond itself is paying 5%. So this is the reason why it is a discount bond, right? What is happening if you just simply understand this, it's like this. You have $5 million, let's say, and you give it to someone at 5%, but you could actually invest that money at a 6% return, right? So you would have got 1% extra in the market. If you would have invested it in the market, you would have got 6%. But let's say you gave it to your friend and you gave a 1% discount to them, right? So that's that thing. So that's why the coupon rate here is less than the discount rate, which is why it's a discount bond. So let's calculate that present value that I have been talking about, which is going to be less than 5 million. And let's see how we calculate that. So we press equals to, we type PV, press tab, and the present value formula opens up, right? So the rate that we are going to use is 6%. The number of period is 5, and then the payment amount is going to be, so this is actually the interest or the amount that would be paid, because this is a payable, this is not a receivable. Since this is a payable here, it's already in the question. If you read the second line, it is interest is payable, so that means the company has actually borrowed money. Standard Pacific Shipping has borrowed money from its investors or bondholders or whoever. We don't know about that, and we don't need to guess about that either. But they are going to pay interest. So which is why it is an interest expense and not an interest revenue in this case, right? So you have to pay attention to these terms as well at the same time as we are solving the question. So payment amount, the interest that the company is going to pay on this would be 5 million times that 5%, and which is annual. So we don't need to complicate our this could also be actually, so these bonds or the interest or the amount paid could be semi-annual or quarterly as well, but this is every year. So I have made the question actually rather simple in this case. But if you would like me to make a complicated case here, let's say we do it semi-annual, then we could make another video on that too. But you can also play with the numbers here if you want to do semi-annual. It's not going to be very difficult. And I would probably leave uh, the link to this spreadsheet in the description box below in the video. Uh, so for future value, let's come back to the future value. Let's come back to the video. So future values at the end of the year, we will do to have the number in positive. You can already see the number, it's a negative there. So just to have this in positive, we will do minus PV, and we will get this number as $4,789,000 something, right? So this is actually the present value. So this is actually uh, the present that you see here, this one, right? So that's what it is. Now at year end one, the amount paid would be just simply this times this. That's one column. The second column is about interest expense. So interest expense is going to be the present value. So we will take this number, present value times 6%, times 6%. And the discount in this case would be this number, interest expense minus the amount paid, which is 37,000 something year end bond. So the worth of the bond. So this is worth of the bond or value of the bond at year end one, right? So this is what it is at year end one. So the ending value represents that. Right. So now we all we need to do is just repeat this number for next 4 years until for 2, 3, 4, 5. Right. So we'll just fix the cells here. We'll just play with the Excel in this case. Uh, let's open the Excel formula. So we have this. This is going to be fixed, right? So these numbers. So you can fix by putting the dollar signs here. This number is going to be fixed, and then let's see, in this case, the 6% going to be fixed. So we fix, and then this is, and then this number update, or then it would also update automatically once you, right? So now this is exactly the same as, which should be true. So we have done this correctly. So this number should be exactly the same as the face value of the bond, because at year end, at the year end of at fifth year end, the company is going to pay off $5 million, and it should come at $5 million. The company actually in 5 years will pay $5 million, right? So this is what effective interest method is actually. So there's nothing more to it. It's just simply that. And then of course, you need to make some journal entries about interest expense, and the amount paid. Right. So for example, here the interest, the entry would be, so you would do debit. Let's say I do it for year one, and it would be same for every year. So debit interest expense for this number, it would be this. So I should copy the values only, not Control Shift V. So we copy, and then credit cash, which is going to be, so this is actually the cash paid, and then credit discount amortization. That this is called discount amortization actually. Uh, right, and then that difference would, so this is the difference here, Control C, and then this number. right? So this would be your journal entry. And if you do, debits and credits will always be equal. So you can see here, the green thing here, 287,362.91, it's exactly the same. So this is what, this is the effective interest method. I hope it's simple enough, and it has been explained simply enough to understand how to make this table. Now we will move on to discuss the premium problem, right? So what is premium? So last one was discount. This one is premium. Why is it premium? You would question that, right? So now you can compare this. I have already explained this. You should compare the discount rate and the coupon rate, right? So the discount rate here is still 6%, but the coupon rate is 7%, which means that actually if I lend someone money at 7% and the market is paying me 6%, I'm earning 1% extra here, right? So that's a good thing for me. So it's going to be a premium bond here. And then again, it's 5 million. So 5 billion, right? So let's say again, we will actually, so let's copy the formulas from here. It's just that we will have to tweak things a little bit, but let's do that. Right, so we have this here. First thing would be to look at the present value, right? So the present value is calculated correctly in this case. If you look at the formulas, it's using this one, 6% discount rate at 6%, C2, which is the coupon rate. The C2 is this one here, period 5 years, and then C5 times C4 is the coupon payments, and then C5, which is the the future value, and times 0, right? So this is premium, right? So now this is was so present value of 5 million. Again, we will copy this number from here. So this is the present value of $5 million, right? Um, for premium, we don't do minus, we actually add. Um, uh, that is correct. We actually do minus. So we don't need to change anything here in this case, except we will just check out the formulas. Yeah, so this is 350 is correct. All of this is correct. You can see to just to make this number positive, yeah, you can actually just do because this number is, amount paid is greater than this. So it's just this. Uh, but actually, we would just keep it that because it should be same, right? And then this is also uh, because then this would be minus. So we can do this if we want to make this number positive. So let's do this. Then we would come back to the same number, 5 million. And then yes, right. So we have checked the formulas. So this is the premium. And if you want to do the journal entries, it's just, they would be slightly different in this case, of course, and I would explain. So again, this is just simple table. You just need to use formulas. I've already explained that in discount. For premium, it's just slightly few. For premium, when we calculate the ending value, we just need to deduct from the beginning value. We just need to deduct the premium from the beginning value. So in discount, we need to add back, and in premium, we just need to deduct that number. All right. So we will. So at the year end, at the maturity date, the company will still pay 5 million. It's not going to pay more. It's just that it's worth more today, right? Because of the difference in interest rates, difference in discount rate and the coupon rate. Now here the interest expense is this much, 312 something. You'll take this number here. That's my interest expense. Then debit premium. So we will copy this thing here as premium amortization, right? And that number is 37 something. And then credit cash, which is going to be 350. Right, and when we sum this number, this is going to give me 350, as you can see in green there. the sum, so debits equals to credit. And now this is for year one. You can actually do the same entries for year two, year three, year four, year five on your own. It's just that the numbers will change, but the entry will remain same. I will update this here as well as year one. And that's about it about this video, actually. So the discount amortization or the effective interest method is not a very difficult method, so don't be afraid of it. It's just a simple mere table calculation that you just need to draw this table and follow formulas. As long as you do it, and you can also cross check it. It has a cross check mechanism, right? uh, uh, you can also understand whether it's a discount bond, premium bond, based on the difference in interest rate between discount rate and the coupon rate. And how you can cross check if you have done the question correctly or not is that the ending value, the maturity value at year end will be the same as the face value. So it's same as face value. So I would highlight these two numbers in this case for your understanding. Right, so I hope this video was helpful to you in understanding effective interest method. If this was helpful to you, please don't forget to like this video and subscribe to my channel for more videos like this. You can also comment down below, and please feel free to share these videos with your friends as well who are studying accounting. And thank you very much for watching this video. Thank you.